listen to me closely for a second. If you feel like your paycheck is buying less and less every single month, it is not your imagination.
No, it really isn't.
Right. And more importantly, it's not your fault. The global economy is undergoing this massive, just brutal shift right now. And the middle class, everyday working people are directly in the crosshairs.
Yeah, they absolutely are.
What you're feeling at the grocery store or, at the gas pump or when you look at housing prices, it's actually a historical pattern. And it's playing out exactly on schedule.
We're basically witnessing a mechanism that has repeated itself for centuries. It's a cycle that historically wipes out the wealth of the unprepared,
while simultaneously transferring just massive amounts of power and resources to the few who actually understand how the macroeconomic machine works.
Exactly, the people who see the big picture.
Which is exactly why we're here today. So welcome to this deep dive. Our mission today is to map out this changing world order.
It's a huge topic.
It is, yeah. We are going to expose the underlying mechanics of debt cycles, currency devaluation, and wealth transfer. And the goal here isn't to scare you.
No, not at all.
It's to help you understand how these economic cycles operate under the surface, so you don't get crushed by them, basically. We want to help you build a personal financial life raft.
Because knowledge is only powerful when it's understood and applied.
Yeah.
Once you can see the matrix of how these global cycles function, you stop reacting out of fear.
Right. You start positioning yourself to weather the storm. Okay, let's unpack this. Today, we're pulling from a pretty fascinating stack of sources to build this roadmap.
It's a really diverse stack, too.
It really is. We have a best-selling book on the rise and fall of empires, written by this legendary billionaire hedge fund manager.
A guy who really knows his stuff.
Oh, absolutely. And we also have a viral technology podcast interview with that same author, where he really gets into the geopolitical weeds and all the historical data.
Yeah, that interview was mind-blowing.
It was. But then, to back up all that geopolitical theory with hard economics, we're looking at a Federal Reserve Bank academic paper on redistributive monetary policy.
Which is a bit dense, but we'll break it down.
We will, for sure. Then, to see what this looks like on the ground, we have a World Bank case study on a massive 2016 currency devaluation in Egypt.
That one is really sobering.
It is. And finally, a recent December 2025 financial newsletter that discusses how institutional investors are dealing with what they call the debasement trade.
So it's a lot of material, but they all intersect at one critical point,
Yeah.
The true value of your money.
Right.
And who really pays the price when a dominant financial system reaches its breaking point.
Yeah. That's the core of it. But before we jump into this fascinating conversation, I need to make one thing crystal clear. Disclaimer. This is not investment advice. Always do your own research and consult qualified financial advisors before investing.
Very important to remember.
Always. All right, with that out of the way, let's get into the mechanics of history. I want to start with the overarching framework from our first source. Let's talk about the big cycle.
Right, the big cycle. So this is a framework developed by the billionaire hedge fund manager we're referencing. And he didn't just hypothesize this in a vacuum.
He didn't just guess?
No. He directed his research team to study 500 years of global history, and actually 1,400 years in the case of China.
Wow.
Yeah, just to identify the specific patterns of how empires rise, peak, and inevitably decline. He looked really deeply at the Dutch, the British, the U.S., and the Chinese empires.
And what did they find?
The data reveals that they all follow this highly predictable, archetypal six-stage arc. It operates almost like a law of economic physics.
What stuck out to me is that he isn't just looking at, who won what war or who had the biggest king. Let's look at the data points he actually used. Can you walk us through how he measured the health of an empire?
Sure. So the research tracked the life cycle of these empires using 18 specific metrics, which he calls determinants.
Determinants, okay.
Right. So rather than just looking at military victories, they looked at the underlying engine of a society. They measured things like education levels, innovation, and technology.
The real foundational stuff.
Exactly. Cost competitiveness, military strength, economic output, their share of world trade, and then things like the power of a country's financial center, and ultimately, whether they hold the world's reserve currency.
I want to pause on that list for a second because reading through this, it instantly made me think of a massive tech startup.
Oh, that's a great comparison.
Think about it. A startup begins with this incredible inventiveness and hustle, right? The founders are working out of a garage. Everyone is totally aligned on a single mission.
Yep, the classic origin story.
Right. And because they have no money, They are incredibly cost competitive. I mean, they have to be lean and mean. They value education and engineering above all else.
Because that's all they have.
Exactly. And because of that, they build a better product, they start dominating the market, and eventually they become a monopoly.
That analogy maps perfectly onto the early stages of the big cycle. The cycle begins with a new world order, usually established after a period of major conflict or disruption.
Like a market disruption in tech.
Right. The winning power creates a new system. Then comes a period of peace, prosperity, and incredible productivity. Just like your startup founders in the garage, the society values education, which mechanically leads to innovation.
A chain reaction.
It is.
Yeah.
That innovation leads to new technologies and commercial dominance, which builds massive economic output and global trade.
But you know, the startup story never ends there, right? What happens when that tech company becomes a massive, undisputed monopoly?
They get a little comfortable.
They get bloated. The original innovators, the hungry engineers who built the thing, they leave or they retire. The new management comes in and they just want to enjoy the perks of being on top.
Right, they want the corner office.
Exactly. They start spending lavishly on fancy corporate campuses with like free sushi and nap pods. Their cost of doing business skyrockets.
And their margins shrink.
Yep. And to maintain the illusion of endless hypergrowth for their shareholders, they start taking on a ton of debt. Meanwhile, some lean, hungry competitor is working out of a different garage, getting ready to disrupt them.
That bloat translates directly to the top of the empire's big cycle. As the nation gets richer, its internal cost of living rises dramatically.
Everything gets more expensive.
Right. It loses its competitive edge because its workers are now much more expensive than workers in other hungrier countries. The cultural work ethic begins to shift too.
People want to relax.
Exactly. People feel that because their society is rich, they should naturally enjoy life more and work less.
Which brings us to what the sources describe as the ultimate double-edged sword, the world reserve currency.
Yeah.
The author notes that becoming the reserve currency is the absolute peak of an empire's financial power, but it also contains the very seeds of its destruction. I want to unpack this. What makes a reserve currency so dangerous to the country that holds it?
Well, it comes down to the mechanics of global trust. When a nation is at the absolute top, I mean, when they have the best military, the highest economic output, the most robust trade, everyone else in the world wants to do business in that nation's currency.
Because it's the safest bet.
Exactly. Because it's the dominant, most stable currency. Foreign nations, international businesses, and individuals, they all want to save their wealth in it. This bestows upon the dominant empire what economists call an exorbitant privilege.
Exorbitant privilege. I love that term. So because everyone else is hoarding our dollars, or historically, the British pound or the Dutch guilder, we essentially have a blank check.
That is the practical reality, yeah. Because the rest of the world constantly demands your money to hold as savings or to conduct international trade, you can print and borrow it at artificially low costs.
There's just always a buyer.
Always a buyer for your debt.
I can see how that becomes a trap. The politicians realize, hey, we don't have to make hard choices anymore. We can just borrow to pay for everything.
It's too tempting.
It's politically desirable to borrow and spend because the public only looks at what they are getting. New infrastructure, subsidies, welfare programs, military dominance, and they don't look at the national balance sheet.
Right. The political incentive structure practically guarantees overextension. You just leave the financial cleanup to the next generation.
Kick the can down the road.
Exactly. But mathematically, the debts eventually grow faster than the actual productive economic output. What's fascinating here is how the financial system, which started out in the early stages as a helpful lubricant to foster trade and build real things, mutates.
It changes completely.
It takes on a life of its own. At the peak of the cycle, the rate of return on actual productive investment falls. So instead of building factories or funding research, money flows almost entirely into speculation.
That's another great parallel to the corporate world. It's like a legacy company that stops doing research and development and instead just borrows billions of dollars to do stock buybacks.
That's a perfect parallel.
They aren't creating any new value. They are just engineering the financial paper to make the executives rich in the short term.
Yep. The empire transitions from making things to making money out of money. People just trade financial paper back and forth. But that leads directly to the tipping point.
The edge of the cliff.
Right. The empire reaches a stage where it is spending far more than it earns. The structural deficits are massive. The coffers are bare.
And then something goes wrong.
Always.
Hmm.
And when a crisis inevitably hits an unexpected economic shock, a global pandemic, a major war, the dominant power simply doesn't have the cash reserves or the productive capacity to handle it.
Which forces the leadership into a corner. When a heavily indebted nation hits a major crisis, the sources show its leaders face a binary choice. Option A.
Option A is tough.
Very tough. They can choose a painful economic contraction. They can let bad businesses fail, let the debt wash out of the system, and force everyone to tighten their belts, live within their means, and rebuild from a solid foundation. Or, option B, they can just print more money to paper over the crisis.
And historical data shows they literally always choose option B.
Always.
They always print the money.
Okay, let me push back on this for a second, because this is where I think a lot of people, myself included, get confused. Doesn't printing money help everyone in a crisis?
It seems like it would, right?
Right. I mean, if the economy crashes, people are losing their jobs, businesses are failing, families can't pay their mortgages. By printing money and sending it out, whether through stimulus checks, business loans, or bank bailouts, isn't the government doing the right thing?
It's the most common defense of the policy.
Aren't they stimulating the economy and keeping the whole system afloat so everyday people don't starve?
That is the prevailing narrative, and it's exactly how the policy is sold to the public. But this raises a crucial question, and it's where that Federal Reserve Bank academic paper on redistributive monetary policy becomes essential reading.
Okay, let's get into it.
The stark reality, mathematically proven in this paper, is that money printing is never neutral. It doesn't just float down evenly on everyone in the economy like a gentle snow.
It's not a rising tide that lifts all boats.
Not at all. It actively, mechanically redistributes wealth from one specific group of people to another.
I really want to break down this mechanism because the Fed paper gets pretty dense. How exactly does printing money redistribute wealth? Who is winning and who is losing when the money printer turns on?
To understand the redistribution, we have to look at what happens in the plumbing of the financial system during a crisis right before the printing starts.
Okay, taking a look under the hood.
Right. The paper describes a phenomenon known as the Fisher deflationary spiral. It's named after the economist Irving Fisher, who studied the Great Depression. Imagine a major crisis hits.
People panic.
Exactly. They start selling their assets to get cash because they are scared. Asset prices like stocks, corporate bonds, and real estate, they begin to collapse.
Okay, so the stock market is crashing. Why does that force the central bank to print?
Because of the banking sector. Modern banks hold a massive amount of debt tied to those assets. When the value of the collateral backing those loans collapses, the banks suddenly realize they're essentially insolvent.
Because the MAVA doesn't work anymore.
Exactly. Their assets are worth less than their liabilities.
I'm trying to visualize this. So if a bank lent out $1 million against a commercial building and suddenly that building is only worth $500,000, the bank is sitting on a massive loss.
A huge loss.
They get scared and they completely stop lending money to anyone.
Right. They contract their balance sheets to survive. And when banks stop lending, the overall money supply in the economy actually shrinks. Credit freezes.
So nobody can get a loan for a car or a house?
Nobody. This creates deflation. Now, deflation, falling prices, might sound good to a consumer at the grocery store, but it is a total nightmare for a highly indebted financial system.
Why is that?
If prices are falling, incomes are falling, and money is becoming more scarce, your fixed debt becomes much, much harder to pay off. The real burden of the debt gets heavier.
Because you're earning less, but the loan amount is the same.
Precisely. If this spiral continues, massive corporations default, banks go under, and the entire financial system collapses.
So the central bank steps in. They look at the cliff edge and say, we cannot let the banking system fail or society stops functioning.
They feel they have no choice.
So they create new money out of thin air and inject it into the system to stop the deflationary spiral. They buy government bonds, they buy mortgage-backed securities, they lower interest rates to zero. They essentially flood the financial sector with a fire hose of liquidity.
And here is where the redistributive mechanism kicks in. When the central bank prints that money, where does it go first?
It definitely doesn't go to my bank account.
Exactly. It does not go into the checking accounts of everyday workers. It goes directly into the financial system. It recapitalizes the banks and drives up the prices of financial assets, stocks, bonds, real estate.
So the people who own those assets win.
Big time. So if you are in the top 1% or 10% of society and you own a massive portfolio of these assets, your net worth absolutely skyrockets. The newly created money artificially pumps up your wealth before it ever reaches the real economy.
But what if you're in the middle class? What if you are a working class person who doesn't own a stock portfolio or a rental property empire?
That is the tragedy the sources highlight so clearly. The middle and lower classes rely almost entirely on wages, their hourly pay, or their salary.
And wages don't shoot up overnight.
No, wages historically do not rise nearly as fast as the new money supply is expanding. Eventually, all that newly printed money leaks out of the financial sector and makes its way into the broader economy.
And when it gets there,
Now you have vastly more currency chasing the exact same amount of physical goods and services. This causes consumer price inflation.
so the cost of food, rent, gas, and electricity goes up. The middle class sees their purchasing power quietly destroyed. It's a hidden, regressive tax.
That's the perfect way to describe it.
The government doesn't have to pass an unpopular law in Congress to raise your income tax by 15%. They just print money, devalue the currency currently sitting in your wallet, and use that stolen purchasing power to bail out the financial system and enrich the asset owners.
The academic paper explicitly states this. It argues that monetary policy acts like a contingent wealth tax. It tempers wealth shifts for the financial sector at the direct expense of those holding nominal cash or relying on fixed wages.
That is wild.
The billionaire author's historical analysis of the big cycle confirms this perfectly too. At the end of every empire cycle, you invariably see a massive widening of the wealth gap
The rich get astonishingly richer.
through asset inflation, while the poor and middle class get squeezed dry by cost of living inflation.
Which fuels extreme political and social polarization. I mean, think about what we see on the news every day. When people feel like the system is rigged, when they are working harder than ever, putting in overtime, but still falling further behind, they get incredibly angry.
And rightfully so.
The billionaire author's internal conflict gauge shows that as this wealth gap widens, you get populism flaring up on both the left and the right. You get civil unrest, protests, strikes, and you eventually get a breakdown of the internal order of the country.
Now, if we connect this back to why we are doing this deep dive, this is why understanding the cycle is so crucial for you, the listener.
You aren't just imagining that it's getting harder to survive.
Exactly. It's not a personal failure. The late-stage monetary system is mechanically designed to devalue your labor in order to service the massive debts accumulated at the top of the empire cycle.
Which transitions us perfectly to our next major source, the December 2025 financial newsletter. Because let's be honest, for a long time it felt like the middle class was doing okay, right?
It did seem that way for a while.
From the 1980s up until fairly recently, a lot of people were buying houses, their 401ks were generally going up, life seemed relatively prosperous. What changed to make it so brutal right now?
The newsletter author points out something profound. What changed is the end of a 40-year macroeconomic tailwind.
A 40-year tailwind.
Right. Starting around 1980, the global economy entered a unique 4-decade cycle of constantly lowering interest rates. Back in the early 80s, interest rates were in the double digits. Mortgages were at 15% or higher.
Crazy to think about now.
Over the next 40 years, central banks slowly walked those rates all the way down to literal zero.
That's like riding a bicycle downhill for 40 years. You feel like you're a world-class athlete because you're moving so fast, but really, gravity is just doing all the work for you.
I love that analogy.
When interest rates keep going down year after year, borrowing gets cheaper and cheaper.
That downhill slope reduced the cost of borrowing to buy assets, which heavily incentivized taking out leverage. It artificially pumped up household net worth across the board.
Real estate is a great example of this.
The best example. If you bought a house in 1990, the ever-decreasing mortgage rates meant that new buyers could afford larger loans, which kept pushing the value of your house up for 30 years, regardless of whether the physical house was actually improved.
Just purely based on cheaper debt.
Exactly. But that era, that long downhill ride, is now over. Interest rates hit their absolute floor at zero. They can't structurally go any lower to keep artificially boosting asset prices.
So the tailwind is gone. We're at the bottom of the hill. What are we facing now?
We are entering a new macroeconomic era that the newsletter describes as the gradual print, or an environment of interest-adjusted debasement.
Interest-adjusted debasement. Okay, break that down.
Because the debt levels globally across governments, corporations, and individuals are still astronomically high, central banks are trapped. They can't raise interest rates too much, or they will bankrupt their own governments who have to pay the interest on the national debt.
Because the interest payments would just eat the whole budget.
Right. But they also can't lower them anymore because we hit the floor. So to keep the massive debt bubble from imploding, they will have to slowly but continuously print money.
So they establish a floor under nominal asset prices, meaning the stock market might not crash in dollar terms, but they slowly bleed out the true purchasing power of the currency underneath it.
The money supply will just keep growing to service the unpayable debt. Institutional investors know this is the only mathematical way out, which is why the newsletter talks about the debasement trade.
What are the smart money guys doing?
Smart money hedge funds, family offices, massive institutions, they are actively looking for ways to de-dollarize or move out of fiat currency altogether, because they know the purchasing power of that currency is guaranteed to decline.
I want to really ground this theory in reality, because macroeconomics can sound a bit abstract when we just talk about charts and money supplies. I want to look at history to see how this actually feels for the people living through it.
Historical context is so important.
Let's dive into case study 1, the Dutch Empire. This totally blew my mind when I was reading the sources. The Dutch basically invented modern capitalism in the early 1600s, didn't they?
They absolutely did. The Dutch Golden Age is a perfect microcosm of the big cycle. Around 1602, they established the Dutch East India Company, or the VOC, which was essentially the first multinational corporation.
And they needed a way to fund it.
Right. To fund it, they created the first modern stock market. They pioneered capital markets, allowing everyday citizens to buy shares and fund these massive, risky voyages to Asia to bring back spices and luxury goods.
And they had an incredible rise. They were the scrappy startup of the 17th century. They innovated ship designs, building the flube ships that could carry massive amounts of cargo with very small crews.
Total game changer.
They completely dominated global trade. Because they were so dominant and their financial system was so trusted, the Dutch guilder became the world's undisputed reserve currency. The sources noted that at their peak, an astonishing 25% of all new inventions in the world were coming out of the Netherlands.
That is a staggering statistic.
They were the Silicon Valley of their era.
But then, as the billionaire author's model predicts, the big cycle played out. All that incredible wealth pouring into Amsterdam led to a fundamental shift in their society.
They hit stage 5.
The classic transition occurred. The Dutch citizens, the descendants of those scrappy shipbuilders, became incredibly wealthy. They traded their wooden clogs for fine silks, and as a result, they became less hungry.
They got comfortable.
Their cultural work ethic changed. They wanted to enjoy their prosperity rather than toil in the shipyards.
And their labor became incredibly expensive.
They completely lost their cost competitiveness. Meanwhile, just across the channel, the British were watching closely. The British learned how to copy the Dutch ship designs. But because British labor was still cheap and hungry, they could build those same ships for a fraction of the cost and man them with cheaper sailors.
So the British start aggressively undercutting them in global trade. But the Dutch are still sitting on the world reserve currency. So instead of rolling up their sleeves, innovating, and competing on cost, they take the easy way out.
They rely on their exorbitant privilege.
Exactly. They just start borrowing heavily to maintain their high standard of living. They transition from a productive economy that builds the world's best ships to a financialized economy that just trades paper debt.
And then the catalyst arrives. When an external shock hit, in their specific case, it was a series of incredibly costly naval wars with the British and a disruption to their crucial trade routes.
Yeah.
The Dutch coffers were bare.
They were overextended.
They had massive debts, their industrial productivity had stalled, and their currency was dangerously overextended. The empire crumbled under the weight of its own bloat, the guilder lost its reserve status, and the British took over the New World Order.
Just completely disrupted.
The cycle completed itself exactly as the 18 determinants predicted.
It's a perfect, tragic blueprint. But that was hundreds of years ago. A listener might think, well, that's interesting history, but it doesn't apply to my life today. I want to bring this into the modern era to show exactly what a currency crisis looks like for the people living through it right now. Let's look at case study 2.
The Egypt case study.
Yes, the 2016 currency devaluation in Egypt, documented meticulously in the World Bank paper.
This is a vital case study to explore because it strips away the theory and shows the immediate visceral impact of these macroeconomic forces on the working class.
It's the reality on the ground.
Egypt in 2016 had been facing severe macroeconomic imbalances. They had dwindling foreign currency reserves, slowing trade, and a massive debt load they were struggling to service.
So they were up against a wall.
Totally. To manage this crisis and secure a $12 billion bailout loan from the IMF, They had to agree to strict structural reforms.
And the biggest, most painful reform was allowing their currency, the Egyptian pound, to float freely on the open market rather than the government artificially pegging its value.
Right, they had to let the market decide what it was worth.
Prior to November 2016, the government held the exchange rate at roughly 8.78 Egyptian pounds to $1. Almost overnight, when they let the market dictate the price, it lost more than 50% of its value. It crashed to over 17 to the US dollar.
The economic fallout on the ground was brutal and immediate. We have to remember how global supply chains work. When a country's currency loses half its value, anything the country imports, wheat, fuel, medicine, electronics, suddenly costs twice as much in the local currency.
It's instant inflation.
The World Bank researchers specifically tracked the exchange rate pass-through to commodity prices. They found that 4.5% of the exchange rate changes passed directly to consumer prices almost immediately.
Within days.
And cumulatively 15.5% over the next 6 months.
The numbers in the report are staggering. Inflation rates overall soared above 30%, and basic food prices shot up by over 40%. Just imagine that for a second as a listener. You wake up on a Tuesday, you go to the grocery store, and the exact same bag of rice, the exact same carton of milk costs 40% more.
It's terrifying.
But your paycheck hasn't changed a single cent.
And this brings us to the core injustice highlighted in the research, which mirrors exactly what the Federal Reserve paper on redistributive monetary policy warned about. Who suffered the most? The researchers found unequivocally that the poorest households were hit the absolute hardest by the devaluation.
I'm trying to wrap my head around that math, to be honest. If a gallon of milk goes up 40% for the millionaire living in a mansion in Cairo, and it goes up 40% for the factory worker, inflation is hitting them both at the exact same rate. Why does the World Bank say it acts as a regressive tax? Why is the worker hurt so much more?
It comes down to the mechanics of consumption patterns and asset ownership. A wealthy household might spend 5% or 10% of its total income on tradable goods like food and essential energy.
It's a tiny fraction of their budget.
Right. The vast majority of their wealth is tied up in savings, services, or hard assets like real estate and foreign stocks. But a household at the bottom of the income distribution spends over 50% of its total income just on basic caloric survival.
Food. Just trying to eat.
So when food prices spike due to a currency devaluation, it consumes almost all of their disposable income. It acts as a massive regressive tax on the poor because they have no margin for error.
The researchers actually calculated a metric they called the compensating variation. They looked at how much extra money a household would need given to them just to maintain the exact same standard of living they had the day before the devaluation.
And what did they find?
For the average household, the devaluation accounted for over 50% of the total rise in their cost of living. But for the bottom quintile, the poorest 20% of society, the burden was disproportionately higher.
The tragedy is that they had no financial shields to protect them. They didn't own foreign currency accounts. They didn't own commercial real estate or international stocks that might have adjusted upward in value with the inflation.
They were totally exposed.
They only had their local currency wages, which were essentially cut in half in terms of global purchasing power. It is a stark, modern, incredibly well-documented warning of what happens when a sovereign debt and currency crisis resolves itself through devaluation. The middle and lower classes bear the entire brunt of the adjustment.
Okay, let's take a deep breath. We've covered a massive amount of intense, heavy history and economics today. We've seen how empires rise and fall, how late-stage debt cycles force governments into a corner where they have to print money, and how that money printing actively, mechanically steals purchasing power from the working class.
It's a lot to process.
It is. So what does this all mean for you, the listener? How do you survive this shift? If the system is designed to devalue your labor, how do we build that financial life raft? Let's get into the actionable takeaways in true Wealthnetic style.
The first and most critical takeaway for the listener is to embrace what institutional investors are calling the debasement trade. You need to look closely at what the smartest, largest pools of capital are doing right now to protect themselves.
Follow the smart money.
Exactly. They are diversifying away from paper money. They are quietly de-dollarizing and moving out of fiat currencies.
Let's define fiat currency really quickly for anyone who isn't familiar. Fiat is essentially government-issued money like the US dollar, the euro, the yen, that isn't backed by a physical commodity like gold or silver.
It's money by decree.
It only has value because the government says it does, which means they can print an infinite amount of it with a keystroke. And if you know the central banks have to execute the gradual print just to keep the debt system from collapsing, you know the fiat currency sitting in your checking account is guaranteed to lose value over time. So how do we protect our purchasing power?
You protect it by researching and diversifying into hard assets. Hard assets are tangible, finite things that cannot be printed out of thin air by a central bank committee.
Give us some examples.
This includes things like physical gold, real estate, and specific equities or businesses that provide essential value and can raise their prices along with inflation. You want to own a piece of the productive physical economy or a provably scarce store of value rather than holding the unbacked paper debt of an overextended empire.
That makes perfect sense. Own real things. Takeaway number 2 is a mental shift, and I think this might be the most important one. You need to start calculating your interest-adjusted returns. This concept from the newsletter is absolutely brilliant.
It completely changes how you look at investing.
We are so culturally trained to look at nominal numbers, just the raw digits on a screen. You look at your high-yield savings account and see a 5% yield, and you think, great, I'm making a 5% profit this year.
But nominal numbers are an illusion in an inflationary environment. You have to measure your financial progress against the rate of monetary expansion, not just the nominal dollars.
So factoring in the printing.
Right. If you are earning a 5% return in that savings account, but the total money supply in the economy is expanding by 7%, you are not making money. You are actually secretly losing 2% of your true wealth every single year.
It's like having a bucket that's catching 5 drops of water from the ceiling, but there's a hidden leak in the bottom, losing 7 drops. Your slice of the economic pie is getting smaller, even if the absolute number on your bank statement is getting bigger.
It's a great visual.
You have to subtract the real inflation rate or the money supply growth rate from your yields to see if you're actually moving forward or backwards. If your interest-adjusted debasement is negative, sitting in cash is a guaranteed loss, which gives you an incredible incentive to invest in almost anything else that holds value.
Which leads directly to our third actionable takeaway. Minimize toxic debt and aggressively invest in your own personal determinants. From a debt perspective, we need to be nuanced. In an inflationary environment, having fixed-rate debt on a productive asset like a 30-year fixed mortgage on a rental property can actually be a hedge.
Because the payment doesn't change.
Exactly. Your monthly payment stays the same, but you are paying back the bank with future dollars that are worth significantly less.
But high-interest variable consumer debt like credit card debt or adjustable-rate personal loans will absolutely crush you during these macro shocks. When inflation spikes and central banks try to temporarily fight it by jerking interest rates around, those variable rates on your credit cards will skyrocket and drown you.
It's a trap.
You have to eliminate toxic debt. It is financial quicksand.
And finally, we should look back at those 18 determinants of a successful empire that the billionaire author identified. The fundamental truths that make a nation successful over a 500-year cycle are the exact same fundamental truths that make an individual successful over a 50-year career.
I love this concept. Let's apply it directly to the listener. Determinant number 1, education. Upskill yourself continually. Read books, take courses, understand how AI and new technologies work.
Never stop learning.
Determinant 2, innovation. Figure out how to do your job faster, better, or in a completely new way that adds massive value to your employer or your clients. Determinant 3, competitiveness. Make sure the specific value you provide to the marketplace makes you indispensable.
You want to be irreplaceable.
If you build your own personal economy on these strong fundamentals, your income potential will remain robust no matter what happens to the global reserve currency.
By doing that, you are building personal resilience against macroeconomic fragility. You are making yourself anti-fragile.
Exactly. Okay, let's do a quick recap to bring this all home. History and data prove that empires and reserve currencies do not last forever. They run on highly predictable, multi-century debt cycles.
Like clockwork.
When a nation's debt gets too high, they lose their competitive edge and the cycle turns. To avoid immediate collapse, governments will historically always choose to print money. This printing devalues the currency and mechanically, ruthlessly shifts wealth away from the middle class and into the hands of asset owners.
That's the painful reality.
But by understanding this machinery, by diversifying your portfolio into hard assets, by measuring your true interest-adjusted returns, and by investing in your own irreplaceable skills, you can take control of your financial destiny and build that life raft.
And as we wrap up, I want to leave you with a final provocative thought to mull over.
Hit us.
We've established today that history shows every single fiat reserve currency eventually fails, and is replaced by a new one from a rising nation-state. But what happens to the big cycle when the entire globe is digitally connected in real time?
Oh, wow.
If trust in centralized fiat fails globally, could the next reserve currency not belong to a nation-state at all?
That is a massive paradigm-shifting question for the digital age. If you found value in this deep dive, make sure you subscribe to the Wealthnetic channel and share this with someone who needs to hear it. Your friends, your family, your coworkers. The middle class needs this information right now more than ever.
They really do.
And we want to hear from you. Drop a comment below and let us know what topic you need us to deep dive into next.
The world order is changing quickly, but with the right knowledge and preparation, you can navigate it safely.
Stay Wealthnetic.